All right, everybody, welcome back to another episode of the market overview. So, it's been quite a minute. It's been over a month now since we last spoke, but I wanted to kind of give an update on what we're thinking here, what I'm looking at, and go from there. So, first of all, S&P, things have changed quite a bit. Previously, we were stuck in a pretty tight range, but it's looking like we're expanding downwards now. If we zoom on the daily, obviously this war with Iran, oil prices, that has been causing some major shakeups in interest rates and the S&P. We're looking at downward expansion right now, kind of just seeing daily Bollinger Bands expansion here, consistently trading near the lower part of the bands, which is not good for bulls. So it's just kind of looking like usually the S&P will kind of trade in a channel, and until it breaks that, there's usually no sign of a bottom. I think we're kind of seeing this here. We're either going to see this kind of channel down, or we might actually see this speed up here. Who knows at this point? It's very hard to tell. But yeah, so S&P is officially below the 200-day moving average, which is this line here. Looking to probably trade, I would say in the near term, in the next two to 3 months, probably near towards $600 per share, which would be a $6,000 S&P. So we are looking at quite a decent move down. I was saying on the last video that this was potentially in the cards. So here we go. Not much to say on the Qs, very similar thing. IWM also trading back down as well. I mean, really everything's kind of been correlated. Gold is officially put in a top. We talked about this last time. We had talked about how how it might go up here and then come back down, and it looks like it did that. So if we look at, and it's been a pretty big drop. Like, we are down on the month. Gold is down 16%, which is quite crazy. It makes sense because we've kind of topped, but this chart looks quite terrible. Most likely over time we'll start to slowly trade back to the 200-week moving average, which looks like gold might hit some sort of bottom-ish or be in a buy zone around $3,500 per ounce, which would make sense. That'd be about a 50% pullback, about a 40% pullback, from the all-time high. So that's what I would be looking at for gold. If we look at the new chart I want to kind of showcase, which is the long-term chart. So if we pull up gold on this one, let's pull up the actual Zhao chart, logarithmic. So usually this chart is a 200-week moving average, or a 200-period moving average. And then this is half a standard deviation away from that, one full standard deviation away from that, 1.5, and then 3. So generally the way to look at this is green. The green zones are kind of like a good spot to buy. Yellow might still be like a good DCA, but anything in the red, and especially above the red, is do not buy. Unless you're just trading short term. Like, it's not a good long-term buy. So basically saying anything up here is not a good long-term buy, but anything down here was. And so that's kind of where these numbers are coming in, is this is the 200-week moving average. And so if we can start to slowly trade back down to here as this catches up and this starts to go down, this will end up being a really good buy zone. Silver is very similar. Had a pretty big down month. I think we're down about 26%, so quite a bit more than gold, but it's definitely, this is a very big top, very clear complacency shoulder, move back down. It was very, very aggressive move down. It looks better on the ZAG chart. Quite aggressive. Makes a lot of sense. Still not a buy here for me. Most likely we'll be moving back down to here. I would say the silver bottom will probably end up being $40, but it's probably going to take a long time for this thing to ever go up again and put in a new all-time high. Because here it took about 55,000 days. So we're looking at around, that's literally 14 years. It's a long time. I don't know if it'll take 14 years this time. We're in a very different environment back than we were then, but interesting nonetheless. Okay, let's move on to Bitcoin. So Bitcoin's been, once again, as we look here, it's in the buy zone. This is kind of the same thing with this chart. So Bitcoin still hanging out here, chopping around. I still think this is a good buy. I think if the SPY goes down, continues to crash, if it has like a big crash, I'm guessing this will actually trade a bit lower. But to me, I don't see this thing going much lower. I honestly don't see this thing going much lower than 55,000, to be honest. I really don't think, though, because I think what's going to happen is it'll trade down there, and then it's going to be below the 200-week moving average. Some people are going to be freaking out. They're going to say, oh my God, it's going to trade down to 40K. I feel like 40K is going to be the number that everyone's going to be calling for. 40K, 40K, 40K. Meanwhile, it's just gonna come down and then hit it and then just chop around and then bounce up or something. So for me, basically anything in this kind of region, this is what I'm going to be expecting price to trade through, is this region here for like the next probably year. I don't expect it to go into late 27, but we'll see. I don't know what's going to happen. I just know that this is a good buy. As you can see here from this chart, we're in the buy zone. So this is a good start to this is a really good place to either continue DCAing, starting a DCA, or heading into doing some lump sum stuff. So that's kind of where I'm at. All right, let's look at XLE. XLE continues to do well. And if we look at a relative strength chart, if we look at XLE versus, let's look at XLE versus the SPX, and then let's switch to a logarithmic chart, or percent, excuse me. So you can see here, very clear divergence, especially within the last week or so, or since, let's say, the war started, which was around the beginning before March. So clear divergence where XLE is moving up, energy stocks are doing well because of oil, and S&P is going down. So clearly inversely correlated, which has been really nice. And on this, every time I open TradingView here, I've seen if there's ever a time where the S&P's gone down a good amount, everything would be down except for XLE and I think something else, but usually just XLE. I mean, even bonds have been doing not great. So XLE continues to be a good performing asset right now. It's been a good trade for me. I've been in it for about a little bit over a month now, almost 2 months actually. So it fit my system quite well. As for the long term, if we close that, not a buy here, not a buy. Not something I'll be buying here to hold for the next 2 years, but definitely in the short term has been a good trade. I can see most likely, because U.S. oil is like one of the bigger components of this, I think the oil move might be near done. I don't see this. Well, I don't know. I think betting on it going up from here is a fool's game. Betting on it going down from here is a fool's game. XLE is just continuing to move up for whatever reason. I'm not too concerned. It could be speculation. It could be the companies are doing better. I don't know. I haven't done any research on it, but all I know is that it's performing well, and I will be taking profit at some point once I get a signal. SMH just chopping around, but doing better than the SPYs, of course. Very, very consistent. TLT, a lot of people were yelling about TLT up here, saying, "Oh my God, TLT is going to break up." It's been just in a down only kind of compression phase, and this is where everyone and their fucking mother was buying TLT. And bonds have moved down 5% from there. So, very classic. I would not be touching this ETF, as I have said. I find it to be... there's just no... In my opinion, there's no good case for long-term bonds, long-term duration treasuries to do well in terms of their price. If you want to capture the yield, I guess you could go ahead and do it. I think it's kind of stupid because you're going to lock yourself in. But... I mean, these things are... No one wants these really right now. They're losing demand. Dow Jones, very similar to the S&P. Financial stocks have been trading off quite a bit. And if we look at where they are in terms of the buy zone, they're looking like they're getting near a good buy zone. So this would be a good spot to kind of start dollar cost averaging. I don't personally have a stake in this ETF. I don't ever want to hold this long term just because it's not the kind of stocks I want to hold long term. XLK, State Street Technology sector is, doing whatever. IGV, software stocks, continuing to chop around. Very similar to Bitcoin. They've had a very tight correlation, which I think is going to start breaking soon. But once again, I wouldn't touch this. I mean, this thing is it's done basically nothing since 2021. So I think this is a trader's chart. This is a trader's ETF, but in my opinion, I would not be touching these stocks because I think the technology is being disruptive. I think there's a good chance that we're actually going to be heading into a decade where it's going to be focused more on resources and not necessarily technology in terms of bull markets. I think we're seeing that with XLE. I think we're seeing that with oil. And I think we're also going to be seeing that with XLP. XLP did trade back down, but overall, very good buy on these. A lot of these stocks like Walmart, Costco, I believe, what else is in there? Not Pepsi, but Coca-Cola, doing quite well. So I think this is a good long-term ETF to be holding. In fact, my savings account, I'm going to start adding XLP, excuse me, not XLU. I'm going to start adding XLP to my savings account that way, because it's more of a dividend ETF, essentially. I mean, what's the dividend yield on this thing? The dividend yield is 2.68%, which, considering that it just kind of goes up as long as you buy at decent prices, if you kind of buy and, hold it, you're getting a decent return on a savings, which is good. So XLU, another one that's doing quite well. It's kind of moving up in a channel very steadily. Not as good as XLE. And ARK, which was one I actually had a trade on. I actually closed that on Friday because SPY was trading below the 200-week moving average. And this is kind of where I'm at. If we go to the weekly chart, like I said, green is a good buy. Below this, which is near the 200-week moving average, is an amazing buy. Anything historically near the 200-week moving average on both Bitcoin and the S&P, and pretty much any asset that goes up over time, is an amazing buy. So that's kind of where I'm at. I think right now is a good place to start reconsidering. It's not a good place for short-term trading. There's not a lot of things that are doing well right now, but I think in terms of long-term positioning and long-term outlook, I think this is actually a really good time to start considering what you're going to do. Because one of the things I'm going to do is if the S&P comes down here, I'm going to start buying some long-term buys. If we get something like this, then I'm going to be really in. And maybe I'm wrong, but with long-term stuff, that's definitely going to be where I'm going to be building up here. I don't want to build a long-term position here. I've sold quite a bit of my S&P. In fact, I think I've sold all of my S&P shares. I'm currently very cash heavy, which for me feels really great because yields are continuing to go up. If we look at the US 10-year, actually, let's look at the USO3M, which is the 3-month. These yields are not going anywhere, actually, to be fair. And that makes sense. They're following the federal funds rate, actually. That makes sense because they're so short duration. But if we look at the US 2-year, we have been moving up quite confidently, actually. This is a very, very interesting looking chart, to be quite honest. Sorry for all the stuff on it, but this actually looks quite bullish for yields, which is bearish for bonds. Wow, I actually haven't looked at this chart really closely enough. But yeah, I mean, this is a very bullish chart for bonds, bond yields on the 2-year, which means that, I mean, I could see this going up to 4.5%, which is actually quite crazy. Now, if things go really bad, this thing could shoot up even more. Things going really bad would essentially be we don't get oil prices down meaningfully in the next couple months, because that's gonna the longer that goes on, the more that's gonna factor into other parts of the economy, which is gonna cause inflation expectations. The market's gonna continue to price that in, and that's why yields are going up here. Sure, the chart looks great, but yields are really not going up because of the chart. Yields are going up because the market is demanding higher yields, because people do not want to buy bonds that yield 3.5%. They want to buy bonds that are yielding 4% because they're not sure. That's what they're guessing inflation is going to be at least is somewhere around 4% for the next 2 years. So yeah, I mean, if that continues to happen, then these yields are going to keep going up. And this chart looks like that. It looks like the fundamental analysis is yields are going to keep going up until something changes, and the chart says, hey, this thing's going to keep moving up until it doesn't. So quite interesting, actually. I think this is probably the chart of the video. Um, so yeah. Thank you guys for watching, and I hope to see you guys in the next one. And be safe out there. Make smart decisions. Ask questions. Leave your comments below if you have any questions, and I'd be happy to answer. All right, stay safe.